Welcome to this explainer. Today, we are unpacking an absolutely incredible research paper that exposes a massive, invisible heist hiding right in plain sight within the crypto world. We're going to dive into a fascinating new study titled The Ghosts of Polymarket, When Off-Chain Matches Meet On-Chain Reverts, which was put together by a team of researchers who basically had to turn themselves into digital detectives.
So, before we get into the hard data they uncovered, we really need to ask one big question. How exactly did a simple fraction of a second, just a tiny, microscopic delay in processing, become a highly lucrative loophole for attackers? Well, as you'll see, this paper reveals a vulnerability so subtle, yet so devastating, that it completely challenges how we think about speed and security in decentralized finance. All right, here's our roadmap for today. We'll look at 1. The Polymarket ghost problem. 2. Off-chain meets on-chain. 3. Hunting the ghost fills. 4. 4 methods of attack. 5. The millions at stake. And finally, 6. Beyond Polymarket. Let's jump right in.
Section 1. The Polymarket ghost problem. The fastest-growing app in DeFi has an invisible problem.
You know, Polymarket has absolutely exploded recently as a prediction platform. And if you're trading on fast-moving world events, you obviously want your trades to happen instantly, right? But the researchers found that building for this kind of low-latency speed meant adopting what's called a hybrid architecture. And that specific architecture inadvertently created a massive loophole. It separated the matching of a trade from the actual final settlement of that trade.
Moving on to Section 2, Off-Chain Meets On-Chain, the Fatal Time Gap. Okay, to understand exactly where the attacker struck, think of off-chain matching like a waiter quickly taking your order at a restaurant. It's super fast and efficient. But the on-chain settlement, that's the kitchen actually cooking it and ringing up the bill on the permanent blockchain. It's slower, but it's the final execution. The vulnerability exists because, well, sometimes the kitchen runs out of ingredients before the order is finalized, but the waiter already told you it was a done deal.
And the researchers actually coined a specific term for this. They call them ghost fills. It's an order that is successfully matched off-chain, but then later fails during on-chain settlement because of that consistency gap we just talked about. So the absolutely crucial point here is that attackers recognized this time gap and started exploiting it to intentionally invalidate matched orders before they ever hit the permanent blockchain record.
Section 3. Hunting the ghost fills. Enter Ghost Hunter. How exactly do you catch a crime that leaves almost no trace? Well, the research team had to build a custom detective tool, which they aptly named Ghost Hunter. They used it to dig deep into the blockchain and reconstruct failed settlements from just the faintest on-chain traces. And get this, Ghost Hunter analyzed an astounding 1,952,440 reverted match order transactions. Through that massive mountain of data, they were able to trace these supposed failures right back to concrete intentional attack patterns.
Which brings us to Section 4. 4 methods of attack. The modus operandi. Through their tool, the researchers identified 4 distinct attack vectors used to create these ghost fills. We've got the nonce bump, the balance drain, the allowance revoke, and the proxy trap. Essentially, these are all just incredibly clever ways to legally sabotage a transaction after the fact. And what's wild, and honestly pretty terrifying, is that these 4 vectors didn't just stay static. The attackers kept adapting, evolving them into 35 different variants to continuously manipulate the market.
So why does all this technical maneuvering actually matter? It's because of the absolute advantage it hands the attacker. By perfectly timing something like a balance drain, attackers could essentially cancel a bad bet after they already knew the outcome of a short-term price movement. It made the bet entirely risk-free. The paper points out this enabled risk-free prediction, arbitrage-bot hunting, and even the manipulation of liquidity rewards. It was literally a perfectly rigged game.
Section 5. The millions at stake. The staggering financial damage.
980,133. That right there is the precise number of successfully filled orders that attackers managed to selectively revert using these ghost fill methods. Think about that for a second. Nearly 1 million times, attackers looked at a matched deal, decided they didn't like the outcome, and just pulled the plug before it settled. And this number brilliantly illustrates the real-world impact. Attackers walked away with at least $1.49 million in pure realized profit. Because these attacks were essentially risk-free, this was quite literally just free money being siphoned out of the ecosystem.
But it gets worse. Even more terrifying, the researchers calculated that this exact vulnerability placed a staggering $1.78 billion directly at risk. The sheer volume of capital flowing through these hybrid architecture systems meant the overall exposure was just astronomical.
And it wasn't just a massive financial drain, it was a total operational nightmare for the network. During peak hours, more than 24.3% of all filled orders were reverting. That means nearly a quarter of all the network's matching activity was just failing on-chain. It was acting as a de facto denial-of-service attack on the entire platform.
Talk about ultimate insult to injury. The platform operators were actually the ones footing the bill for all this congestion. The paper details that processing these failed, attacker-driven transactions cost the operator $2.17 million POL, which translates to roughly $212,000 just in absolutely wasted network fees.
Section 6. Beyond Polymarket, the spillover effect.
So just when you think the heist is contained to a single prediction market, the researchers discover a major plot twist. In decentralized finance, code is heavily borrowed and reused. It spreads like wildfire. The researchers scanned the broader landscape and found that code derived from this exact flawed contract still appears in 167 independent contracts. It spans across 10 different blockchains, holding at least $23 million in user funds. The Ghostfill vulnerability isn't just a Polymarket problem. It's a structural contagion across the whole ecosystem.
Thankfully, there's a silver lining here. Well, kind of. The research team practiced responsible disclosure and shared all their evidence with the affected parties. So the issue has now been partially mitigated across the network. But notice I said partially. When an architectural flaw is baked into the very design of how a platform achieves its speed, completely erasing that vulnerability from the foundation is incredibly difficult.
As we wrap up this explainer, I really want to leave you with this final thought. This research fundamentally proves that in the rush to make blockchain apps as lightning fast as traditional finance, developers are creating some very dangerous blind spots. If a smart contract security inherently relies on off-chain speed, what other digital ghosts are hiding in DeFi right now? As long as we demand instant results in a decentralized world, it seems that fatal gap between matching and settling might always be haunted. Thanks for joining me on this deep dive today.